We're back with breaking news, and today we're going to be talking about Blackstone, and they are making a huge bet on UK rental properties to the tune of $740 million. Now, you're going to listen to myself, Piotr, and Saif go through what we think the impact of this is going to be to you as investors and to international institutional investors from now until that money runs out.
Yeah, I think this is it's a really interesting topic. It's quite a timely topic. Obviously, we've seen a shift where the UK government have been really pushing for institutional investors. It's not been a secret. They've been quite loud about it. And I think the Conservative Party have always been pushing for that with Section 24 and all the legislative changes that just pushed out all of the smaller accidental landlords, if you call them that, and then really are pushing for institutional landlords. So, they bought this portfolio of 1,750 homes, and they bought it from Bistreet. So actually, it's a partnership between Blackstone and Regis as well. So Regis have a small partnership in it as well. And they've also set up a management business to manage this property portfolio as well. So the management business is called Leaf Property Invest. I think it's called Leaf Property Investment Partners. And they basically set this sort of management business up to manage it. And all they do really is basically have new builds. So, they are really focused, not necessarily on the build to rent sector, but just more on where developers have basically built these properties out and they might be a few years old and now they're going to be able to buy them without hopefully many issues, pretty good in terms of EPC ratings, etc. And yeah, I think it will form a pretty good investment for them over the long term. But Piotr, what's your thoughts on that?
So I think it's very interesting kind of piece of news for a lot of people. And it may seem like it's a big, massive company. It might not be relevant to small investors. However, I think news like that is very relevant to small property investors because it just shows where the money flows, and it also shows the confidence in the UK property market and the UK residential property market. And businesses like Blackstone make investments, it's backed up by a huge amount of research. And Blackstone very rarely loses money, and they've got the best researchers, analysts, managers, investment managers in place. And basically, when they make a decision like this, it's backed up by a huge amount of research. So it just shows indirectly to small property investors confidence in the UK residential property market. And also, what I think it highlights is this purchase is 750 homes at $580 million pounds. So that equates to about £340,000 per one unit, which is probably not a bad price for the Southeast. Depends where exactly in the Southeast it is, but it's quite a good investment, I think. When it comes to those big investments into new build homes, this will be quite a big thing across Europe and as well in Poland, where a lot of funds purchased from or did deals with new house builders, and basically purchase offline a lot of investments, and it works really well for those listed companies because obviously they can show the income coming in, and they can show it's basically like a forward funded investment. I think this happening more and more in the UK is very much the result of government policies, but as well the confidence in the market.
Yeah, because the UK was always, institutionally, the UK was never really seen as a kind of big play. Germany was a big play, the US was a big play for a lot of these institutions, but we did have a securitized income on the UK property assets from a regulated place. Jay, do you want to just talk a bit about sort of Granger and Mount View and all the rest of it, and how they looked at the UK property market as a securitized asset really class from that perspective?
Yeah, so I mean, these are like large family offices that became mid-sized institutions, and some of them are even listed now. So like Granger and Mount View are listed, and they take a very, very long-term view. They were going into secondary or tertiary residential ownership. They were looking at blocks primarily, and blocks where some of the tenants in those blocks had pre-existing and enhanced residential rights. So they had some kind of protected tenancy, so pre-1990, whatever it was. And their hold was simple. They would be buying roughly market value, including the tenancy at the time, which would be underlet because it'd be registered rent normally. But they knew that over a period of time, the capital value of the units that didn't have those protected tenancy rights, they could sell those off and they'd only be left with 1 or 2 units per block. And that's how they started kind of scaling up. And then they changed the model around. They changed it to not actually sell any of the flats in the block. They wanted unbroken freehold blocks. And then they started selling those off. But that was 2020 time. And you still see them like Pears Group, Granger, Mount View. There's another big one that always skips my mind, but I literally used to work across from their London offices. And these Peabody, there you go. But these are some really big institutional style investors. And I think, with Blackstone coming in, it's a very winnable bet, if you would call it a bet. I think it's a very sound investment choice. The UK has consistently and historically become a solid investment territory.
Because the regulated tenancies were creating that securitized income for these funds, wasn't it? Because people lived in them until they either passed away or maybe passed it down. And actually what it did was it created an environment where these funds had tenants that were looking after the properties as if it was their own, because effectively they were living it for the rest of their lives most of the time. And they had to make sure they paid their rent because they didn't want to lose these really, really high valuable assets to the renters at that point, right? Because obviously they're paying really low rents for what they are. And they effectively own the properties, but they're only paying a rent on them that's probably lower than any mortgage you can pay. So it created an environment of low operational activity for these funds and guaranteed, if you want to call it that, income, right? Which is ideal. But obviously we moved away from regulated tenancies in the UK. And I think this is probably the next best thing, right? Because commercial property offers securitized income for a lot of these funds, but also we saw what happened with the likes of Debenhams on a 20-year lease, House of Fraser, blah, blah, blah. It's really disrupted the market. So I think now residential property proposes a really, really good option for them where they've got capital appreciation over the long term. They've taken all the risk out of development because they're buying these pretty much ready-made. And also they're getting they're pretty much getting them from an asset management perspective where they can put the rents up year on year, which is going to be massively valuable for them. And they're going to get capital appreciation of the southeast. But this isn't the first time, by the way, they've bought this from this developer. So they actually bought, I think it was around about 2,800 homes last November. So they've already added a significant amount to their portfolio from this developer. But what it does do for UK developers is it offers them an exit. Because where people like Persimmon and Taylor Wimpey and stuff are reducing the amount that they're developing because they're seeing slower house sales, these guys are now like, I've got a guaranteed exit. I'm going to go out and develop more because all I have to do is develop and these guys will buy it from me and they create liquidity.
This is really, really important is if you're an institutional investor and you look at the UK market, and if you pay any attention to what's going on, you'll see that developers are one of the most at-risk groups in terms of entrepreneurs or businesses in the marketplace because they go bust more than anybody else goes bust. So you have to think to yourself that governments, not just in the UK, but large swathes of Europe and the rest of the country, at least for the last 10 years, haven't been investing in building new homes. They've been changing the regulations around existing homes, EPCs, all these different types of things. They haven't been investing in actually building new homes. And then you had a couple of years ago the removal of if you had a new build development, someone could buy it and they'd get their deposit matched and all that kind of stuff to help to buy thing, which massively helped developers. Wasn't always the best solution for most buyers, but massively helped developers. And you could look at this as almost a replacement of that in terms of the developer was to build these things out and build them out on a build to rent standard, knowing that it's going to be harder wearing, it's going to see a transition of tenants over time, etc., etc. I think that's a really strong position if you're a developer now, thinking, right, well, how do I start building these things at volume and at scale, where it will attract an international institutional investor such as Blackstone? I think that's huge for the UK economy and huge for developers who have had a real rough time of it the last 15, 20 years.
I think it's important that this happens just before the election, and where everyone is expecting Labour to come in power and change all kind of the rules of their game for residential landlords. Yeah, I think it shows real confidence. And we are actually going to discuss some of the Labour policies on the property market. So make sure you follow us, subscribe, and look out for the next video.
Theo, I'm going to leave the listeners with with a stat. This is how exciting the UK property market is right now to be an investor over the long term. So the Office for National Statistics actually brought forward their estimate of when the population is going to hit 70 million from 2037 to 2026, which is 11 years, right? So they think the population is going to hit 70 million in 2026. And we've definitely not got enough infrastructure. We've definitely not got enough houses to add. So I think that's also part of the excitement where you've got people like Blackstone coming into the market, where obviously we've got a shortage of housing, and actually, yes, being a developer is great, but also actually being able to bring back a lot of homes that have been left empty and unoccupied for a while into use, and owning asset class like retail and residential property investment is actually quite exciting over the next couple of years. So just a thought for everyone to you all.
It is. Okay, well, thanks very much, guys, for watching, and make sure you subscribe and watch another video on our channel. See you soon.